Selling put options looks like easy premium. Until it isn't, because one bad trade, one bad stock, or one bad position size can wipe out months of small wins. So in this video, I'm going to show you the beginner-safe way to sell puts, how it works, how to pick strikes, and how to manage assignments using the wheel strategy. When you sell a put, you're making one simple promise. If this stock falls to this price by this date, I'll buy 100 shares. In exchange for that promise, you get paid up front. That payment is the premium. Let's use a real-world example. Say stock XYZ is trading at $105. You could sell a put with a $100 strike price that expires in 1 month. For making this promise, you might get paid a premium of $2 per share. Since one options contract controls 100 shares, you would immediately collect $200 in cash. Think of it like being an insurance company. You're selling downside insurance to another investor who is worried the stock might fall. There are 3 possible outcomes. First, the stock stays above your $100 strike price. The option expires worthless, and you keep the full $200 premium. There are 2 ways people sell puts. The first is a cash-secured put, which means you have enough cash set aside to buy the 100 shares if you're assigned. In our example, you'd need $10,000 in your account. The second is a naked put where you don't have the cash and are instead using margin or leverage. If you're a beginner, the rule is simple. Start with cash-secured puts only. With a naked put, a sharp drop in the stock price can lead to a margin call, forcing you to liquidate your position at a massive loss. Cash secured means if you get assigned, you don't panic. You just buy the shares like you planned. Before you sell any put, follow these 3 rules. Rule 1. Only sell puts on high-quality stocks or ETFs you'd be happy owning long-term. Assignment is not a failure. It's part of the strategy. Rule 2. Never risk money you can't afford to deploy. Next, you need to select an expiration date. For beginners, the sweet spot is typically 30 to 45 days to expiration, DTE. This gives you enough time to manage the trade if it goes against you. It also takes advantage of accelerating time decay, or theta. Theta is the rate at which an option's value declines over time, and as a seller, theta is your best friend. This is also why ODTE, or same-day expiration options, are not for beginners. There's no time to fix mistakes. A sudden headline can hit, and you're trapped with no room to manage the position. Now, how do you pick a strike price? 2 beginner-friendly tools can help. First, use delta as a rough guide for probability. A 0.20 delta put has, roughly, an 80% chance of expiring out of the money. For beginners, a delta between 0.20 and 0.30 is a good starting range. Second, look for strikes near obvious technical support zones on a chart. If a stock has bounced off a certain price level multiple times in the past, it's a logical area to get paid to agree to buy it. This is where many beginners make a mistake. They try to squeeze every last cent of premium out of a trade by holding it until expiration. A better approach is to have a clear profit target. A common rule is to close the trade and take profits once you've captured 50% to 80% of the initial premium. If you collected $200 and the option is now worth $40, you can buy it back, lock in an 80% profit of $160, and free up your capital for the next trade. Holding on for that last $40 isn't worth the risk. But what if the trade goes against you and the stock falls below your strike? You have 2 choices. You can accept the assignment and buy the 100 shares, or you can roll the trade. This means buying back your current put option at a loss and simultaneously selling a new put option with a lower strike price or a later expiration date, or both. Often, you can do this for a net credit, meaning you get paid even more premium to give yourself more time and a better price. If you do get assigned, you now own 100 shares. This is where the wheel strategy comes into play. You've completed step 1, selling a cash-secured put. Now that you own the shares, you move to step 2, selling a covered call. This is a promise to sell your shares at a higher price. You collect premium for this promise, generating income while you hold the stock. If the shares get called away, you're back to cash, and you can start the wheel all over again by selling another put. Finally, let's cover the biggest beginner mistakes. First, selling puts on low-quality speculative stocks just because the premium is high. Second, oversizing your position. One contract is a bigger financial commitment than it feels. Third, treating this like gambling instead of a structured, rules-based strategy. The edge in this game comes from discipline, not excitement. Selling puts rewards patience, discipline, and repetition. Start cash secured, pick quality names you'd actually own. Use the 30 to 45 DTE window and always manage your trades proactively. Thanks for watching, and I'll see you in the next one.